U.S. natural gas prices hovered close to the $2.80 level, rebounding from the over one-month low of $2.72 as markets gauged evidence of lower supply against muted demand. New data from the EIA showed that natural gas stocks in the United States rose by 33 billion cubic feet, missing expectations of 43 billion cubic feet build and remaining sharply below averages from the end of the second quarter. Nevertheless, the anticipation of reduced demand constrained the recovery. Seasonally cooler weather reduced the outlook on air conditioning use and gas consumption in the short term, although meteorologists still forecast temperatures to remain mostly hotter than normal until mid-September. Also, reduced operations at domestic LNG export facilities, including Cheniere Air Energy's Sabine Pass and Corpus Christi, have prevented a greater supply draw from national territory. Meanwhile, the gas rig count continues to decline. The U.S. gas rig count declined by 1 to 113 during the same week, while it fell by 53 compared to last year. Workers at Chevron's LNG projects in Australia, which produce 5% of the world's supply of super-chilled fuel, went on strike on Friday after mediation talks ended without a deal. Unions kicked off action with short work stoppages and bans on certain tasks, but plan to escalate to a total strike within 2 weeks if there is no deal. Until next Wednesday, workers will stop work for up to 11 hours in several blocks per day and refuse to perform certain tasks, including working overtime. If there is still no deal by then, the unions will completely stop work for 2 weeks. Based on preliminary calculations by a data intelligence firm, the work stoppages through to September 14 would see limited impact, with around 95,000 tons or 1.5 cargoes worth of LNG output removed from the market. Escalations into a full-scale strike would see a wide-ranging impact on output. A prolonged strike could disrupt exports and raise prices of LNG, which is used for electricity generation. European gas prices have been volatile in recent weeks over the labor unrest in Australia and spiked as much as 14% after Friday's news. Volatility in global gas prices despite relatively high inventories across Asia and Europe underscores market sensitivity to potential disruptions, which has increased for most commodities after the Russia-Ukraine conflict started last year and led to a spike in prices. Meanwhile, some insiders from Russia have information indicating attempts to blow up the Turkish and Blue Stream gas pipelines in the Black Sea, and if successful, this could have a significant impact on global gas prices, causing them to skyrocket. The price of natural gas experienced a significant uptick yesterday, closing at $2.77 and putting an end to a continuous 4-session decline. This surge in prices was driven by the recent EIA storage report, which exceeded analysts' expectations, emphasizing the heightened dependence on gas, particularly during extreme climatic conditions. Given the present data and market reactions, a bullish trend is anticipated in the short term. The current market sentiment remains bullish as the current price of $2.82 hovers above the former resistance at $2.80. A sustained move over the $2.80 level will indicate the short-term buying pressure is getting stronger, with a retest of $2.90 as the next likely target. Nonetheless, a significant challenge lies ahead at the $2.99 threshold. Overcoming this obstacle is essential to set the stage for reaching the 200-day moving average and potentially aspiring to attain the $5 level, a long-term target that is presently in view. Please don't forget to hit the like button and turn on your notifications bell if you enjoyed the video. See you in the next one.